This inflation that has been ongoing, it's not a decade old, it's not 2 decades old, it's not even half a century old. It's been around for approximately 90 years, and I'm counting back from 1933. Why 1933? Because that's when the dollar-gold exchange rate was fixed at $35. That's when FDR, Franklin Delano Roosevelt, changed it, or whoever was advising him, probably not him, altered it from $21 to $35. At that point, the deflation from $21 an ounce to $35 an ounce was sufficient to bring the price system back into balance, I would say, and sustain things. But ever since, the continuous money printing has been constant. They attempted to falsely claim a gold-dollar exchange rate of $35 until 1971. In 1971, they stopped deceiving and declaring a gold ounce as exchangeable for $35 because it wasn't. However, this inflation has persisted since the shift to $35. So, that's around 90 years, but concerning whether it can persist for another decade, I'm skeptical. I recall my childhood back in I didn't hear about everyone being in debt all the time. Some people were struggling, but I lived in a middle-class, upper-middle-class area where individuals generally had savings, were upwardly mobile, and enjoyed a high standard of living. However, I remember a shift around 2006, 2007. People started going into debt to buy houses, and then they faced losses. Debts from that time are still looming. Nowadays, people everywhere are in debt. I don't know anyone except affluent individuals who aren't significantly in debt. It's during these turning points that things can implode. What I anticipate is a gradual decline. I'm uncertain how long it will take, possibly a few months, maybe a year. So many significant developments are occurring deep within the core of the monetary system that any unforeseen trigger could set off a chain reaction. What I foresee happening, based on historical patterns, is a controlled erosion of the dollar's purchasing power. I'm not referring to its value against other currencies. I'm talking about its purchasing power in terms of tangible goods you can acquire with it. Prices will continue to rise, as nearly everyone, even the staunchest fiat currency proponents, realizes this is not sustainable. They understand that this entire system is flawed because debt continually accumulates and never decreases. You can't maintain any system like this. It goes against the natural balance of things. Nature doesn't operate this way. Nature achieves equilibrium, but this system doesn't. It accumulates indefinitely. Everyone knows it's doomed. However, at a certain point, when it becomes evident that the dollar is genuinely losing its purchasing power, that's when it can all unravel rapidly, perhaps within weeks or even days, similar to Weimar, right? We've witnessed hyperinflation before. It occurred here in Israel in 1984. It happened in Weimar in 1923. It occurred in numerous countries, but only within isolated currencies that always had a benchmark currency to return to. The distinction now is that it's the benchmark currency itself, the dollar, that could crash. And then where will all the other currencies pegged to the dollar go? They can either revert to gold, or the entire monetary system could implode, necessitating the introduction of private currencies, which could be more stable in the long run but lead to more short-term chaos. Just like in Weimar, we observed an inflation that spanned from around 1918, after World War I, to 1923, but it escalated dramatically in mid-1923, taking about 5 or 6 months. The only thing that held it back then was the need to physically distribute paper currency. You had to move it on trains and physically hand it to people. Nowadays, none of that is required. Transactions are instantaneous, whether it's Bitcoin, Apple Pay, or any other method. Bitcoin is essentially another form of the dollar, in my view. However, you can dispose of dollars instantly, just like that. You can spend it all within seconds. We've never encountered hyperinflation within this kind of technological environment of a base currency, like the dollar. So, it could be that food prices double in a month, then double again the next month, and a few days later, just crash. Nobody knows because we've never witnessed this before. Qualitatively, we've seen something similar, but quantitatively, not to this extent within the current technological context of money transfer. I'm not sure about the details, but I'd advise protecting yourself before any of this transpires. The only reason the dollar has any value is because it can still be converted into a certain amount of gold, provided only a few people do so. If everyone does it, gold could reach a price of approximately $40,000 per ounce. I calculated this based on the Fed's balance sheet, divided by the quantity of gold in Fort Knox, supporting that balance sheet. If we harken back to the Great Depression and the economic upheaval that was revealed, when gold shifted from $21 to $35, that was around 60%. Imagine the catastrophic depression that could result from gold suddenly surging to $30,000 in a few weeks. It's difficult to contemplate. I don't believe we should even contemplate it this way. It's not exactly an increase in the price of gold. It's the collapse of the dollar. It's the dollar losing its purchasing power. If the monetary exchange rate between gold and the dollar were abruptly adjusted to $5,000, what do you think would happen? What would occur is that everyone would rush to claim their gold immediately. And it wouldn't stop at $5,000. Once it reaches $5,000, it would approach the real monetary exchange rate, assuming there is one, assuming there is gold in Fort Knox. It wouldn't stop at $5,000. That's the peril. That's what we're talking about. At some point, it wouldn't be a gradual erosion of the purchasing power. It would go from, let's say, $2,000 to the next day $3,000. I'm not certain about the numbers, but if you look at commodities priced in gold under this scenario, commodities would be quite affordable in terms of the gold price because that's genuine money. It's what lends the dollar its purchasing power, the gold backing it. It's not at a fixed rate, but it's still there because you can exchange it for gold. So, once it reaches $4,000, $5,000, the free market would swiftly drive the dollar to its monetary parity, based on the balance sheet of the Fed divided by the audited gold holdings in Fort Knox.